A home appraisal can feel like a simple price tag, but it is really a risk check for the lender. A buyer may love the house, a seller may accept the offer, and both sides may think the deal is finished. Then the appraisal comes in lower than expected, and suddenly the entire transaction has to be renegotiated. A home appraisal is an independent opinion of a property's value, usually ordered by a lender during a mortgage transaction. The appraiser does not decide what the buyer wants to pay emotionally. The appraiser estimates what the property is worth based on condition, location, recent comparable sales, and market evidence. The lender cares because the home is collateral for the loan. If the buyer stops paying, the lender may need to recover money by selling the property. If the loan is much larger than the property's realistic value, the lender carries more risk. The appraisal helps prevent lending based only on excitement or negotiation pressure. An appraisal is not the same as a home inspection. An inspector looks for defects, safety issues, roof problems, plumbing concerns, and repair needs. An appraiser may note obvious condition issues, but the main question is value. A house can pass appraisal and still have repair problems that an inspection reveals. Comparable sales, often called comps, are central. The appraiser looks at similar homes that recently sold nearby. A 3-bedroom house is compared with other similar 3-bedroom houses, not a luxury property across town. The closer the comps are in size, location, age, and condition, the stronger the value estimate becomes. Appraisers make adjustments when homes are not identical. If one property has a renovated kitchen and another does not, the appraiser may adjust the value. If one has a larger lot, extra bathroom, garage, pool, or better condition, those differences matter. The goal is not perfection, it is a supported estimate. A low appraisal can create a gap between the purchase price and the lender's approved value. If a buyer offers $500,000 but the appraisal comes in at $470,000, the lender may base the loan on the lower number. The buyer then needs more cash, a lower price, or a changed agreement. Imagine a buyer with a 10% down payment who wins a bidding war. They offer above asking because several buyers compete. The appraisal comes in lower because recent sales do not support the new price. The buyer may still want the home, but now their financing math no longer matches the offer. Sellers sometimes assume the highest offer is the best offer. But if the offer depends on financing, appraisal risk matters. A slightly lower cash offer may be stronger than a higher financed offer if the appraisal is uncertain. Sellers and agents often look at both price and likelihood of closing. An appraisal contingency gives the buyer a way to renegotiate or leave if the property appraises below the contract price. In hot markets, some buyers waive this protection to look stronger. That can help win the house, but it also means the buyer may need to cover the appraisal gap from savings. Condition affects appraisal because buyers usually pay more for homes that need less work. Fresh paint alone may not transform value, but major updates, functional systems, layout, and visible maintenance can matter. Deferred repairs can hurt value because they reduce confidence and may increase the cost of ownership. Location remains one of the strongest drivers. A similar house near good transport, jobs, schools, parks, or quieter streets may appraise differently from one near noise, poor access, or declining demand. Appraisers do not value the building alone. They value the property in its local market. Fast-changing markets create appraisal tension. Prices can rise faster than closed sales data. Since appraisals rely heavily on completed sales, they may lag behind bidding activity. This is why appraisal gaps often appear during hot markets with limited inventory and aggressive buyers. Appraisals also matter in refinancing. A homeowner may want a better rate or cash-out refinance, but the lender checks current value. If the home appraises lower than expected, the owner may not qualify for the loan amount they wanted or may face different loan terms. Appraisals can sometimes be challenged, but not simply because someone dislikes the number. A strong reconsideration usually provides better comps, factual errors, missing upgrades, or incorrect property details. Emotional arguments rarely help. Evidence matters because the appraisal itself is supposed to be evidence-based. An appraisal is not absolute truth. It is a professional estimate made at a specific time for a specific purpose. Two appraisers may not reach the exact same number. The market price is what a buyer and seller agree to, but the appraised value is what the lender is willing to support. For buyers, the practical step is to understand appraisal risk before making an offer. Ask whether recent sales support the price. Decide how much cash you could use if the appraisal is low. Do not assume the lender will finance the full offer just because you and the seller agreed. For sellers, the practical step is to price with evidence, not only hope. Strong photos and staging may attract buyers, but the appraisal still looks at comparable sales and property facts. If the likely buyer needs a mortgage, the sale price must survive lender review. A home appraisal is a bridge between the emotional deal and the lender's risk calculation. It can confirm the price, force renegotiation, or reveal that the market evidence is weaker than the offer. Understanding that role helps buyers and sellers avoid surprise when financing enters the picture. Appraisals often surprise buyers because emotional value is not the same as market-supported value. A buyer may love the kitchen, school district, sunlight, and memories they imagine making there. The appraiser is looking for evidence, comparable sales, condition, size, location, upgrades, and recent market behavior. Comparable sales are usually the backbone of the appraisal. If similar homes nearby sold for less, the appraiser has to explain why this home deserves a higher number. A beautiful renovation may help, but it does not automatically erase the evidence from recent sales in the same area. Condition matters in a practical way. A home with a new roof, working systems, clean structure, and permitted upgrades is easier to support than one with hidden repairs. Cosmetic beauty can influence buyers, but appraisers also look for defects that affect safety, livability, and long-term value. For sellers, a low appraisal is not only a buyer problem. It can force renegotiation, a price reduction, a larger buyer cash contribution, or even a failed deal. Pricing too far above supportable evidence may attract attention at first, but the appraisal can bring the deal back to reality. Lenders care because the home is collateral for the loan. If the buyer stops paying, the lender wants confidence that the property value supports the amount borrowed. That is why a lender-ordered appraisal can affect financing even when the buyer and seller already agree on price. The appraisal does not ask, "How badly does someone want this home?" It asks, "What value can be supported by the property and recent market evidence?" That difference matters. A smart real estate decision respects both the human desire to buy and the financial evidence needed to close safely.